CNBC TV 18's Lessons in Leadership.
So let's now talk about what's happening as far as the U.S. economy is concerned and what the Fed is expected to do. Because every time we have an FOMC meeting, everyone in India is watching what the Fed is going to do, what the Fed is going to say, whether it means funds flowing out of emerging markets like India. Do you believe that the fear of Fed action is exaggerated at this point in time? And really the route to normalization of fund rates, it's a systematic path that the Fed seems to be following at this point in time.
Well, I think the fundamental economy is what the Fed will pay attention to, the data as they call it, and they're very clear about it. The minutes are transparent, the points of view are transparent, the dots they publish as their outlook are transparent, and the analysis of that is voluminous, right? But if you step back and look at the economy from what we see, our team projects next year the U.S. will grow a little over 3%. And so what we see that's very positive about the U.S. is consumers are spending money. Unemployment levels are down. Housing is constructed with 1 million units starting. Existing home sales are solid. Auto sales remain strong. You're seeing real estate construction and commercial construction come back, which is important in the U.S. It's nothing more important for local economy. And so the question that everybody wonders is, when will the Fed raise rates? And the market has it in the late summer to fall of next year. And the reason... But they've had it there every year for the last 5 or 6 years. And so the question is going to come down to when they feel that the economic, the wage area, the labor is constructed up. They've been very clear about that. And so it's just not the unemployment number. It is a simple fact that people believe and feel, and there's enough wage demand that they can earn more in the future. And that's not there yet, because the efficiency of the operational processes are not putting a lot of wage demand, wage growth. And you'll have to see that correct for rates to move meaningfully in the U.S. And I think they're clear about it. And right now the market says that time next year, a lot of the people speak officially or unofficially on behalf of the Fed, talk about that. We'll see, and that's going to be determined what happens. And the good news in the U.S. is you don't have the issues of going to a confidence killer, the shutdown of the government. The good news is both sides of the political aisle in Congress have kind of said we can't do that stuff. And with that out of the way, I think you have a better picture of the economy in the U.S. ought to grow.
While the Fed is winding down, it's a different story as far as the ECB is concerned, and now even the Bank of Japan, and it seems like there has been a certain coordinated central bank action. The era of stimulus likely to continue? Are we going to continue to throw money at the problem?
Well, I don't think you have a choice, because what you're trying to do is create the conditions of growth, and you see it's taken a long time in the U.S. The recovery period in the U.S. now is longer than the average recovery. So nobody talks about that. So we're deeper than the average recovery. So the probability of what would happen tomorrow by simple math would be that you'd be starting to approach another recession. The reality is that people don't feel we're close, and the experts don't feel they're close, because the recovery's been slower, so it'll last longer. But so this has been a long recovery. But the question is, it's taken that long because the excesses and the resettling and the fiscal consolidation, the labor markets, the housing whatever it was, all those factors.
So the era of stimulus will continue, is likely to continue.
It has to, because until they can get the economies growing, that's the core mandate of the Fed that's consistent. The Fed and central banks around the world is consistent, is to promote growth and the attributes of growth. Employment growth. In the U.S., they have a unique dual mandate. So I don't see how central banks ease without there being very constructive conditions for people to get jobs.
Since we are talking about the central bank and central bank actions, Mr. Ambani, let me ask you this. How significant is it going to be to actually see whether it's a 25 basis point rate cut or a 50 basis point rate cut or a 75 basis point rate cut, which is what most people are estimating the RBI will do in 2015 to actually jumpstart growth? How significantly is that going to impact starting up of the investment cycle? Because the investment cycle is yet to take off.
Absolutely. And I think it should happen in February. Inflation is under reasonable, we have a path to reasonable control with what's happened on the external side. And I would expect that to be a continuous process and add to confidence both on investment as well as consumption. Let's also not forget that interest rates are also very important for the individual consumers in terms of each one of us looking at our EMIs and our ability to consume on housing and our ability to consume on consume goods, as well as for companies and as well as for small businesses to invest. So yes, that my own view is that that has to happen, because the only way interest rates can go now is down, not up.
But when do you really see domestic capital being put to work by corporations?
Well, I think that India offers a huge opportunity. So fundamentally, I think investment virtually in every area for big and small corporations, right? We will be capital short for a long time to come.
Right. When people ask that question, I was with clients, the amount of capital investment going on a routine basis, and the telecommunications infrastructure, the general infrastructure, it's already a big number. And so what you're trying to say is, can you increase that a lot? That takes the financing power and the confidence and things like that. But I think people forget that there's a lot of capital being invested by business around the world today, in relatively modest growth.
What are they telling you? Which are the areas where we are likely to see foreign direct investment flow in?
I think
we've seen liberalization in defense and the railways and so on and so forth. What are they telling you?
The idea of going from 25 to 50%, and people can invest more by its very purpose. But I think more fundamentally, what the world needs to figure out, help India figure out, is the financing structure for some of these longer-term projects, and that's a tough assignment in any market. And I think it's up to teams like ours and other of my competitors to help figure that out and help create financing structures where Mukesh can get longer term financing, so he can build, he or other similarly situated companies can build these big projects and have confidence they can lock in the financing and not get caught.
Which are the sectors, Mr. Ambani, besides the ones that you operate in, that you feel we're going to really see significant growth? Brian's talking about infrastructure financing. We're seeing the government as well as the central bank move towards making it easier for companies in the infrastructure space deal with the problems that the sector has been faced with. We've seen FDI being liberalized across a bunch of sectors. Where do you actually see money coming in, and which are the sectors that you're most confident about?
Well, I've always believed that all business, there is difference between business and charity. So you do charity for a purpose, but businesses always chase return. So all investments chase return. And fundamentally, if you see India and see our last quarter, what actually happened was agriculture grew.
Yeah.
So in my view, agriculture is a great opportunity. We have the potential again to double our yields, and there is enough happening on technology, just like we talked about in the oil business, to do that in agriculture. Within industry, and I take the general industry framework, right? We are 17% of the world's population. We are 2% in terms of contribution to manufacturing output. And now in real terms, even in labor costs, we are 1/3 of China. So, industry, and this is across, provides a great opportunity, and this is really across all industry segments. If you then take infrastructure, which I segregate as a separate piece, right? We are perpetually infrastructure short. So whether it be power, whether it be telecommunications, whether it be energy, right? Those opportunities exist. The challenge there is exactly what Brian said, is how do we really create financing and governance structures so that infrastructure is fair to users of infrastructure as well as fair to investors. And then finally there is services.
Yeah, you preempted my question. I'll come to services in just a bit. But on the issue of the regulatory overhang which the infrastructure sector is faced with, the issue of politicizing tariffs in this country has been a significant issue as far as infrastructure is concerned. Do you believe that we're moving towards a path where these are going to be less of an issue, and we are actually going to see private sector participation move back into these areas?
I think that we will have to have a part to what I call mature governance, right? And the recognition that any investment will need returns. That return has to be fair and transparent, right? And it has to be fair not only to the investor, but it has to also be fair to the user of that infrastructure. So if I have a rail service, or if I have a port service, or I have an energy service, right, I should be able to afford the output after giving me a fair return. And government, so it's really a three-way partnership between consumer, what the government wants, and what the investor wants.
CNBC TV 18's Lessons in Leadership.